Welcome to Singapore, where English is flawless, PowerPoint decks sparkle, and somehow the scoreboard still says you're behind. Everyone speaks boardroom English. Everyone understands finance jargon. Everyone can pronounce liquidity, yield, and asset allocation without blinking. And yet, a suspicious number of people are sprinting very fast just to remain exactly where they started. Here's the paradox that pays my rent. Singaporeans don't lose because they can't communicate. They lose because communication has been mistaken for power. English is the interface, not the operating system. You can pitch like Goldman, negotiate like McKinsey, and still discover the real money already moved 3 quarters ago. Let's talk stocks. Retail investors here read the same headlines, watch the same CNBC clips, and buy the same safe blue chips. By the time your aunt finishes explaining dividends over Kopi, institutional money has rotated, hedged, and shorted your optimism. Fluency didn't help, timing did. And timing belongs to capital with faster pipes. Now real estate, the national sport disguised as stability. English lets you read the brochure. Capital decides who owns the land. Prices go up, yields go down, leverage goes up, and the dinner conversation goes quiet. You didn't misunderstand the contract. You understood it perfectly. You just weren't the one writing it. Money flows don't care about accents. Funds chase tax efficiency, regulatory arbitrage, and scale. When global capital reallocates, it doesn't ask whether your English essay scored an A. It asks whether your market is liquid enough to enter and small enough to exit without consequences. Guess which box gets ticked? This is the uncomfortable truth. English made Singapore efficient. Efficiency made it investable. Investability invited global capital. Global capital raised asset prices faster than wages. And now people wonder why mastery of the language didn't translate into mastery of outcomes. So no, Singaporeans aren't bad at English. They're too good at it, mistaking polish for leverage. The game isn't about speaking well, it's about owning first, moving early, and exiting clean. If this chapter made you mildly irritated, good. That irritation funds the next one. Like the video, subscribe. The algorithm understands incentives better than most humans, and we're going to use that. Singaporeans love to say they're financially literate, and they are. Dangerously so. They know what ETFs are. They understand diversification. They quote Warren Buffett at dinner like it's scripture. Meanwhile, capital already left the room and locked the door. Let's start with stocks, because hope dies fastest there. Retail investors are told to be patient, long-term, disciplined. Institutions are told to be liquid, tactical, ruthless. Guess who wins? By the time the average investor finishes a perfectly articulated English post about undervaluation, high-frequency traders have scalped the spread, hedge funds have hedged the hedge, and the market has moved on out of boredom. The cruel joke is that financial education increased participation, not advantage. More people entered the market with confidence, not control. Liquidity rose, volatility tightened, margins shrank. Congratulations, your knowledge made the market more efficient, and efficiency is fantastic if you already own scale. Now property, the sacred cow that eats everything in sight. You are told property is safe. Property is stable. Property is generational wealth. All true, just not for you. Prices rise faster than wages, mortgages get longer, and down payments turn into endurance sports. You speak flawless English to the bank manager while signing a 30-year obligation that assumes your job, health, and the global economy will remain cooperative. Bold assumption. Who actually wins? Funds, developers, REITs. Capital pools that don't live in the unit they own. When interest rates shift, they rebalance. When regulations change, they restructure. When yields compress, they exit. You, on the other hand, attend a seminar titled How to Optimize Your Home Loan and Feel Productive. Money flows reward speed and insulation. Singapore is small, open, and hyperlegible. That's wonderful for global finance. It's less wonderful for locals competing against sovereign wealth, private equity, and cross-border capital that treats your housing market like a spreadsheet cell. English didn't fail Singaporeans. It succeeded too well. It made the system transparent enough for outsiders to exploit, and competitive enough that insiders had to overextend just to keep up. The result is elegant and depressing. Everyone understands the rules. Fewer people can win under them. If this sounds familiar, that's because you're living it. Like, subscribe. Not because it helps me, because attention is the only asset retail still controls, and we're going to deploy it recklessly in the next chapter. Here's the part nobody likes, so naturally it's the most important. Singaporeans are not losing because they're lazy, unskilled, or confused. They're losing because they have no pricing power, and English, ironically, helped remove it. In a globalized market, English is not a weapon. It's a standard setting. Once everyone speaks it, nobody gains an edge from it. You become interchangeable. Highly competent, very polite, perfectly replaceable. Let's talk labour markets, the quiet massacre. When your English is excellent, you don't compete only with your neighbour. You compete with the entire English-speaking world, including people who cost less, demand less, and complain less. Multinationals love this. Workers don't. Wages flatten, expectations rise, and performance reviews turn into survival rituals. Now add capital mobility. Companies can move profits. Funds can move money. Talent, however, has mortgages, aging parents, CPF constraints, and a nervous relationship with risk. Capital floats, humans sink roots. Guess which one negotiates harder? Speaking of CPF, the national masterpiece of discipline and delayed gratification. Forced savings sound responsible. They are. They're also illiquid. While global investors shuffle assets across borders at light speed, locals watch a very respectable number grow slowly in an account they can't fully touch. Stability is great. Flexibility wins wars. Then there's consumption optics. Luxury cars, premium condos, Michelin meals. It looks like prosperity. It feels like prosperity. Underneath, leverage quietly accumulates. People aren't rich, they're financed. English lets them explain this very clearly to each other, which is comforting but not corrective. The brutal truth is this. English integrated Singapore into global markets at full exposure. Full exposure without pricing power means you absorb shocks instead of setting terms. You don't control wages. You don't control housing prices. You don't control capital flows. You just understand them extremely well while they pass through you. This is not failure. It's structural submission dressed up as sophistication. If this chapter stings, good. Pain is the last honest economic indicator. Like the video. Subscribe. Attention is leverage. We're almost at the part where it starts to matter. Corporations are polite liars. Now comes the part everyone pretends not to notice. Singaporeans aren't losing to foreigners because foreigners speak better English. The real winners also speak perfect English. They just happen to own assets, structures, and exit routes. Welcome to the upper layer. Private banking English, family office English, capital preservation, intergenerational transfer, jurisdictional optimization, same language, different universe. While middle-class professionals debate mortgage rates, this group debates which country their money should belong to this year. Let's talk wealth concentration, because silence here is expensive. Asset inflation didn't happen accidentally. It happened because policy protected capital first and wages later. Stocks were supported, property was defended, liquidity was guaranteed. Labour was told to upskill, reskill, and smile harder. And it worked. For asset holders. In equities, insiders don't chase returns. They manage exposure. Losses are tax events. Gains are optional. Volatility isn't feared. It's harvested. Retail investors ask whether to buy or sell. Capital asks whether to enter or exit the jurisdiction entirely. In real estate, the divide is surgical. One group buys to live, the other buys to park value. One worries about interest rates, the other negotiates with banks like partners. When prices rise, both cheer. When prices fall, only one has dry powder. English makes all of this sound reasonable, polite, technocratic. Nobody screams rigged. They say market dynamics. Nobody says locked out. They say cooling measures. Language doesn't hide the truth. It sanitizes it. And here's the cruel symmetry. The better Singaporeans play by the rules, the more predictable they become. Predictability is comfort for planners and profit for capital. The system doesn't punish effort. It simply doesn't reward it proportionally. So who's winning? Those with assets before the boom. Those with mobility after the boom. Those who treat countries like balance sheets. Everyone else is fluent, diligent, and permanently one cycle late. If this feels uncomfortably accurate, good. Comfort is how people stay stuck. Like, subscribe. This channel doesn't sell hope, it sells clarity, which oddly pays better. Here's the ending nobody budgets for. Singaporeans didn't fail the system, they fulfilled it perfectly. The system just wasn't designed to let most people accumulate decisive advantage. Perfect English created perfect compliance. You understand contracts. You follow rules. You optimize within constraints that were never meant to bend for you. That's not incompetence. That's containment with good manners. Look at the full arc. English integrated Singapore into global capital markets. Capital markets inflated assets faster than incomes. Policy protected stability, not mobility. Mobility belongs to capital. Stability belongs to labor. This is why the feeling is so specific. Life looks successful, the city gleams, the resumes are strong, and yet there's a quiet realization that no matter how articulate, educated, and disciplined you are, the finish line keeps moving. You are not poor. You are permanently pre-wealth. The final irony is vicious. Singapore sells itself as meritocratic. And it is. Merit determines how efficiently you serve the system, not how much of it you own. Ownership is inherited, accumulated early, or imported. Effort mostly maintains velocity. So why are Singaporeans losing? They aren't. Losing implies a fair game with a bad outcome. This was a well-run game with predetermined ceilings. English helped you see the ceiling clearly. That clarity hurts more than ignorance ever could. If you stayed until here, you already know this wasn't about language. It was about leverage, timing, and ownership. Language was just the brochure. Like the video. Subscribe, not out of loyalty, out of self-interest. This channel exists to map systems before they close above your head. End of series.